How about business uses? How can you use this? And there's lots of different ways here. We just want to talk about a couple of things. If you have a small business, you may want to have something called a key man policy. Say there's 4 people working in the business, only one person is the sales guy. If that sales guy dies, what happens to the business? You may need an insurance policy that will cover till you can train another person to take that guy's place. If you have a partnership, what happens if one of the partners dies? Well, we have to have a way for the partnership to ultimately buy the interest so that they can pay that money to the heirs of the partner. So we may need to have policies to cover that. Group life insurance is something that we're all familiar with. Many companies offer group life insurance. Your book talks in some detail about some of the peculiarities of group life, but in general, your company is allowed to give you $50,000 a year tax-free. So up to $50,000, there's no tax. If your company offers you, let's say you make $50,000, and your company offers you double life insurance, so you're going to get $100,000. Somehow you either pay for the $100,000 or you're not $100,000, the extra $50,000, or you're taxed. You have to pay for it, or you get taxed for it. So there's lots of different ways the way business can ultimately use life insurance. Your book obviously talks about the variety of ways. These are actually really more business questions than personal finance questions. And again, we talked a little bit about those policies here. Here's how one of the split dollar policies work, and these were actually quite popular. So I mean, if you're working in the industry, you may find them out there. The challenge is the IRS has changed the rules, and now there is a tax that's designated when the person ultimately dies here. But essentially, what happens? We have an insurance company. There's an agreement, that's between the employer and the employee, and they kind of split the fee. And then later on, when the person dies, the insurance company splits the payment. It's a split dollar, and some of that ultimately then becomes taxable. Some other kinds of issues, obviously, we have to worry about some other documentation, right? I mean, what happens if you put life insurance into a trust? We actually have a picture of that, right? Here's a life insurance trust, right? So here we have Mr. and Mrs. Jones. They create this irrevocable trust, so it's a gift that cannot be given back. And from that, they actually have a life insurance policy. They use cash. They give cash to the trust. The trust then buys the life insurance. So at death, when one of those folks dies, the life insurance pays money to the trust. Assets go to the heirs. Some of the trustee's going to use some of that, obviously, to pay for the estate and estate taxes, but also the remainder then ultimately goes to the heirs of the account. So if you're thinking about life insurance planning, we really have to ask just some very simple questions. The example in your textbook, quite frankly, I think is, I've tried to follow the math, and I have challenges trying to follow that. But I think it's actually a lot simpler. There's really 5 things that we have an interest in thinking about. Should you or do you want to replace your income? Do you want to pre-fund your kids' college education? Do you want to pay off debts? Do you want to provide for final expenses and taxes? And do you want to leave a legacy? Once you've answered those questions, you can calculate the life insurance need. Once you know how much you need, you then have to do some shopping. What is the best type of policy for your need? Find an insurance company that you like, and then obviously purchase the policy. So let's think about this. I mean, what are the expense needs? There's some very short-term needs, right? Final expenses, close the estate, debt liquidation, emergency fund. Those things are very single period kinds of things. But the multiple period things are retirement needs for your spouse, survival income for your spouse, kids' needs, educational costs. The challenge is, outside of your life insurance, there are only 4 places that you can get money, right? Social Security could help cover some of these multi-period costs. Group life insurance could help cover some things. The spouse has earnings, they could cover those costs. And investment income could obviously cover some of these costs. Life insurance, though, is to ease the burden on spousal income and investment income, right? We don't want to put pressure on the remaining family to cover the expenses that they'll need in the future. So, once we find out our ability to fund the premium payments, where's that money going to come from? We need to talk about the amount of death benefit. We've already talked about that. What's the need? Are we going to be replacing policies? There's many, many questions once we decide how much life insurance we need. Again, we're still talking about the characteristics, the things that you want to cover. We need to think about the insurance company that you're going to pick. What is their financial stability? What's their service like? Quite frankly, one of the big questions, and it shouldn't be, is the reputation for paying claims. How fast are they in making payments of claims? I mean, it would be nice that once you provide a death benefit, that in the next 2-3 days you should have a check. That doesn't always happen. Insurance companies do not want to give up this money. And again, in the end, we have to look at pricing. What is the price of the insurance that we're going to be acquiring? To find out about the financial strength of the companies, we use rating agencies, much like we use for bonds, right? There are these rating agencies. AM Best is one of the more popular insurance ones, and Fitch's is an insurance premium company, and they rate things exactly the same way that they rate bonds, right? We have this rating system, A at the top, A++, AAA, however you want to write that. That's at the top. Going down the alphabet gets to a point where companies become more and more risky with respect to payment and even ability to make payment. So we're going to finish up the chapter talking essentially about, well, how do you calculate the value, the amount of life insurance that a person needs? Well, let's think about this. We have the wife is 28 years old. They got a couple of kids, right? What kind of insurance are they going to need? They need here essentially $3,000. They're going to get $664 comes from the Social Security benefit until the youngest child gets 18, right? They're going to get $1,600 until the younger child gets to be 16. They have a lack. There's something that's missing here, but between the time when this person gets to be 18 and this person's now gone, there's 2 years where there's going to be a lack of income. They need more insurance needs. We also need some insurance per month because from widow's unemployment, she might be unemployed for a while. And then ultimately we need to get out to retirement age for the widow. So there is absolutely a life insurance need. How do we figure out those amounts? I mean, here we have a financial statement for a couple, right? Essentially, they got $112,000 worth of assets, and they have $50,000 worth of insurance. But if you look at this, they have a $90,000 house that they owe $70,000 on. They actually have other liabilities. They owe $82,000 in total liabilities, but they have $50,000 worth of life insurance. So this family is far undershort because the only thing we've covered here is part of the home mortgage. We haven't covered any potential education needs, any potential income for either one of the spouses should the other one pass. So we need to ask some questions about these clients to make sure they have the kind of insurance that they really need. The easier format than the text is really just to ask 5 simple questions. Do you want to pay off the mortgage? Do you want to pay off your consumer debt? Do you want to pay for your kids' college education? Do you want to pay for final death expenses? And finally, do you want to have some monthly income to replace the lost income? So There is a spreadsheet. It's called the Life Insurance Needs Spreadsheet. You look at it, it's right here is the worksheet version of that. You can see how it gets filled out with obviously yellow boxes. But you fill in the amounts, the answers here. Well, how much is your mortgage? How much is your consumer debt? What do you need to pay for, if you were going to pay for your kid's college education today, how much would you need? How much do you want to put there? What should the final expenses be? And then you ask the two clients, the primary and the spouse, you ask them what you want if the other person dies. So when you ask the primary, right, so let's say this is the husband, we ask them, so like, look, if your spouse dies, do you want to pay off the mortgage? You don't ask him if he dies, does she want him to, it's a personal question that the person remaining has to answer. So in this case, you know, if the primary dies, the spouse says yes, 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 all this stuff needs to be covered. But if you're asking for the spouse's coverage, you're asking primary, says no, you know, I have enough money, I can cover the consumer debt, I can cover the kid's college education. All I want to do is pay off the mortgage and pay off final expenses. Plug in the amount you know. Well, what's the monthly income that you need, right? What's the time level? This should be time, not dollars. What's the rate of return that you expect? Well, here's one. How do you figure out what your monthly income should be? Well, let's just write the things down. What is the current monthly income? $4,500, $2,500. What are the expenses? Here's the mortgage. We're going to cover that. Debt expenses, that's $900 a month. The amount that you're going to save for college education, that's $75 a month. Will there be changes in child care costs? Let's say it's $500. Any other changes in expenses? $300. So for the primary, if the husband dies, we're going to need, you spent $4,500, but we're going to actually need, because these things are all going to be covered with the life insurance, we still need $2,900 a month. If the wife dies, we're only going to need $1,600 a month. So these boxes here are transferred up here to do the calculation. So how much do we need? Well, let's go to this page. You need $175,000 for the mortgage. Here's our final expenses. Monthly income, you're going to need this in a lump sum amount to pay that out over time. So the approximate amount of insurance is the sum of these things. For the primary, we need $530,000. For the spouse, we need $337,000. So roughly, you're going to reduce this up $550,000 and $350,000. How much do they currently have? We plug in those amounts. So that tells us what our shortfall is. So the job now obviously is what? We know how much more insurance we need. What kind of policy are you going to get to cover for this? Remember, though, that when we're talking about this idea of the theory of decreasing responsibility, you only need to cover what a liability when it exists, right? So if you're going to have your house paid off in 15 years, you don't need to have, in this previous thing, you don't need to have this $175,000 worth of life insurance for 35 or 40 years. You don't need to have it that long, right? So as things go away, you may want to have some flexibility to be able to reduce some of the coverages. Quite frankly, you cannot do that very easily with cash value policies. Term has a lot more flexibility. So that's the end of the chapter on life insurance.